SCHD has a reputation for stability and solid dividends. But are you unknowingly sabotaging your own success? This is Prosperity Pulse Point, and if you're investing in SCHD, you probably already know it's a popular choice for those seeking steady dividend income. SCHD, or the Schwab US Dividend Equity ETF, offers a low-cost way to invest in a portfolio of high-quality dividend-paying stocks. With an expense ratio of just 0.06%, it's hard to ignore for anyone looking for conservative, long-term growth. But here's the thing. Many investors make common mistakes with SCHD that could cost them thousands of dollars over time. That's right. Even a solid ETF like SCHD isn't foolproof if you don't know the potential pitfalls. So, today we're diving into 5 critical mistakes that could be eating into your returns, and how you can avoid them. By the end of this video, you'll know exactly what to watch out for to make the most of your SCHD investment. Chapter 1. Mistake number 1. Underestimating expense ratios. Let's kick things off with a mistake many investors overlook: underestimating the impact of expense ratios. Now, SCHD is known for its impressively low expense ratio of just 0.06%. This means you're paying very little to own this ETF compared to others. But why does this even matter? Well, let's break it down. Expense ratios are fees you pay annually, and even small percentages can make a huge difference over time. For example, other dividend ETFs like the First Trust Value Line Dividend ETF, or FVD, have much higher fees. FVD's expense ratio is 0.65%. While that may not seem like a big jump, those extra costs can add up and eat into your returns, especially if you're holding large amounts over many years. With SCHD, you're keeping more of your money working for you. Think of it this way. Paying more in fees for similar funds is like throwing money away. If 2 ETFs deliver similar returns and one charges less, why would you choose the more expensive option? With SCHD, you're getting similar results at a fraction of the cost, and that's a significant advantage for your bottom line. Expense ratios may seem small, but the difference compounds. Over 10, 20, or 30 years, paying higher fees can cost you thousands in lost returns. So, one of the smartest moves you can make is paying attention to these fees. By sticking with lower cost options like SCHD, you'll keep more of your earnings and maximize your gains over time. Avoid this mistake by understanding and leveraging SCHD's low fees to your advantage. Chapter 2. Mistake number 2. Ignoring concentration risk. Next up, we have a mistake that's easy to overlook: ignoring concentration risk. You might think that because SCHD is an ETF, it automatically provides broad diversification. While that's true to some extent, it's important to understand how SCHD's assets are actually allocated. Over 20% of SCHD's total holdings are concentrated in just 5 stocks: AbbVie, Home Depot, Coca-Cola, Lockheed Martin, and BlackRock. Although these are high-quality blue-chip companies, this means that SCHD's performance can be heavily influenced by how these top stocks do. So if 1 or 2 of them hit a rough patch, it can drag down the overall returns of the entire ETF. To add to that, SCHD has a higher weighting in certain sectors, like financials and healthcare. For example, financials make up nearly 18% of the ETF, while healthcare accounts for over 16%. If these sectors face tough times, SCHD could feel the impact more than other ETFs with broader, more evenly spread allocations. So, what can you do about this? First, it's essential to stay aware of SCHD's top holdings and how much weight they carry. You don't need to be an expert, but knowing where your money is going helps you understand the risks. Also, remember that you can still diversify further by holding SCHD alongside other funds or stocks that cover different sectors. Concentration risk isn't necessarily a bad thing, but it's something you need to recognize and plan for. By keeping an eye on SCHD's sector and stock exposure, you can avoid the pitfall of relying too heavily on a few holdings. This way, you can better manage your overall risk and set yourself up for more consistent returns. Chapter 3, Mistake Number 3: Chasing Yield Without Considering Growth. Now, let's talk about a common pitfall: chasing yield without considering long-term growth. SCHD offers a steady yield of around 3.5%, which might not seem like the highest out there, but it's the growth behind that yield that really counts. Many investors get lured by high yields, thinking they'll receive larger payouts. But a high yield doesn't always mean a better investment. In fact, higher yields often come with higher risk or lower potential for growth. For SCHD, the focus is on dividend growth, meaning the payouts have been steadily increasing over time. This makes it a solid choice for long-term investors who want stable, growing income. Here's why dividend growth matters. It leads to compounding. When your dividends increase each year and you reinvest them, you're building a larger base that can generate even more income in the future. SCHD's holdings are chosen from the Dow Jones U.S. Dividend 100 ETX, which focuses on companies with a strong track record of growing dividends. By choosing a fund like SCHD, you're investing in companies that not only pay dividends, but also have a history of increasing them. Chasing high yields can sometimes mean sacrificing this long-term growth. While there are ETFs and stocks that offer higher yields, they often don't come with the same growth potential that SCHD provides. Instead of looking for the highest yield, consider the sustainability and growth of that yield. SCHD's 3.5% might seem modest, but when you factor in consistent growth, it can lead to substantial returns over time. In short, don't get caught up in just the numbers. Look at the bigger picture and understand how SCHD's strategy of dividend growth can contribute to building wealth slowly but surely over the long haul. Chapter 4, Mistake Number 4: Overlooking Rebalancing and Stock Selection. Mistake number 4 is overlooking the impact of rebalancing and stock selection in SCHD. SCHD tracks the Dow Jones U.S. Dividend 100 Index, and it's rebalanced annually to maintain alignment with this index. But why does this matter? Every year, SCHD's holdings are adjusted, with some stocks being added and others dropped based on their dividend performance and other criteria. This means that SCHD's portfolio can shift significantly, which can affect your returns. For instance, a top-performing stock today might be replaced next year if it no longer meets the index's requirements. While this process helps SCHD maintain a portfolio of strong dividend payers, it can also introduce volatility as holdings change. It's important to understand that rebalancing can impact SCHD's composition and your exposure to certain stocks. By staying aware of SCHD's annual rebalancing, you can better anticipate how these changes might influence your investment. This also allows you to diversify beyond SCHD if needed, particularly if you see shifts that may not align with your own goals. So, while SCHD's rebalancing helps keep it on track, don't overlook the potential impact on your portfolio. Knowing what's inside SCHD and how it changes keeps you informed and prepared. Chapter 5, Mistake Number 5: Panic Selling During Downturns. The last mistake we need to discuss is one that can really hurt your returns: panic selling during market downturns. It's natural to feel uneasy when the market takes a dive, but selling off your investments out of fear can lead to significant losses. Here's why this is a big issue with SCHD. Like any ETF, SCHD's value can drop during a market downturn. But selling in a panic means locking in those losses. Historically, markets tend to recover over time, and holding through the lows is often where long-term investors make the most gains. SCHD's focus on reliable dividend-paying stocks means that, even in tough times, it often provides steady income. This is why it's popular with conservative, long-term investors. When you panic sell, you miss out on potential recovery and the chance to collect dividends along the way. For example, during the pandemic, many investors sold at market lows only to watch prices climb back up shortly afterward. Those who held on were able to ride out the storm and benefit from the eventual rebound. By staying invested, you allow SCHD's dividends to keep working for you, compounding over time. Instead of selling, Consider using market tips as buying opportunities. This approach can lower your cost basis and increase your long-term gains when the market recovers. Remember, downturns are temporary, but the losses from panic selling can be permanent. Chapter 6, Conclusion and Final Thoughts. So, there you have it. The 5 critical mistakes SCHD investors often make that can cost them thousands. Let's quickly recap. First, remember to keep an eye on expense ratios, as lower costs mean more money in your pocket over time. Second, don't ignore concentration risk. Knowing where your investments are weighted helps you avoid unexpected volatility. Third, avoid chasing yield without considering growth. SCHD's steady dividend growth might be more valuable in the long run than a higher but riskier yield. We also discussed the importance of staying aware of SCHD's annual rebalancing, which can shift your exposure and impact returns. Finally, try to avoid panic selling during downturns. Market dips are tough, but selling at the wrong time can turn temporary losses into permanent ones. By understanding these potential pitfalls, you're better prepared to make the most of your SCHD investment. Remember, success with SCHD is about patience, awareness, and staying informed. Stick to your strategy, stay focused on the long term, and you'll be in a better position to reach your financial goals. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and share it with others. See you in the next one.